What role did the Great Depression play in banking safety? Imagine losing your life savings overnight because a bank suddenly collapses. That was a harsh reality for many during the Great Depression. This period in the early 1930s revealed huge weaknesses in how banks operated. Nearly 9,000 banks failed, wiping out about $7 billion in depositors' money. Back then, banks did not have insurance to protect people's savings. When banks failed, depositors lost everything, which made people very afraid to keep their money in banks. This fear caused many to rush to withdraw their funds at once, leading to more bank failures. These panic-driven withdrawals are called bank runs, and they made the banking crisis even worse. The crisis showed that the banking system needed serious changes to prevent such chaos from happening again. Governments realized they had to step in to rebuild trust and protect depositors. This led to the creation of deposit insurance, which guarantees that people will get their money back if a bank fails. This idea was part of the New Deal reforms introduced by President Franklin D. Roosevelt. The goal was to stop bank runs by reassuring the public that their savings were safe, even if the bank had problems. Another important step was the Emergency Banking Act of 1933. It allowed only healthy banks to reopen after government examiners checked their finances. The Federal Reserve, which is the central bank of the United States, was given authority to lend emergency support to struggling banks. This helped stabilize the banking system by preventing more banks from collapsing. The government also promised to reimburse the Federal Reserve for any losses from these emergency loans. This showed that the government was backing the banking system strongly. From a history point of view, the Great Depression made clear that banks needed safeguards like deposit insurance and strong regulation. Without these protections, banks were vulnerable to risky investments and sudden failures. The reforms that followed created safety measures still in place today. These include the Federal Deposit Insurance Corporation, which insures deposits and supervises banks to keep the system stable. The lessons learned from the Great Depression reminded us how important it is to have rules and safety nets to protect people's money and prevent financial crises from spreading.